Jonathan Barratt with us, Chief Investment Officer at ETO Markets. Jonathan, great to have you on. I just want to talk a bit about, the FII figures we've seen from the Indian perspective. And let me get straight to the India story first before we get your view on what Moody's has said on the United States. Just the flows coming back. I mean, in this month so far, you've had close to 29,000 crores coming in from foreign investors. Do you see that India trade sustain?
Yes, I do. I actually think we're seeing a reweighting, and I think one of the interesting pictures at the moment is sort of people saying that the market sort of with the tariffs have readjusted, but now economies which do a lot of trade are seeing more opportunities, and I think these opportunities for more free trade elsewhere in the world is starting to take shape. So I think countries like India, are sort of are bound to get this influx of more capital because people see, well, hang on, we can do more trade cheaper if we look around our region and if I look for other partners which are diverting interest from the States into their other economies. And you can see that quite adequately when you look at some of the DAX, for instance, in Europe. That's going to record highs. Why is that? There's a lot of reasons behind it. And I think one of those is a diversion of trade to new economies. And I think India will definitely benefit from that.
Okay. Jonathan, let's talk about the development. Moody's coming in very late when you talk about the other rating agencies that did this in certain cases years back. So how big of a development is it in your opinion? Is it simply a statement of fact that was already known? And do you think that this flow of capital that has started moving away from the United States, do you think that accelerates?
Yes, I do. I actually think it do. Now, we also remember that we're seeing ratings agencies change, but to get Moody's to change is quite a big thing because they're the last ones. So what is the tipping point that enabled them to say, okay, well, we're going to move? And I think what we are seeing is a lot of, I think it's about $6.5 trillion worth of debt rolling over. Now, one of the reasons Moody's said that they would actually reduce it was because of the size of the interest repayments. And with 6.5 trillion now being rolled over starting in June, the market's going to be concerned on the ability, given where we are with the deficits in the US, the GDP, it's 134% of GDP, which is huge. Given where we are, what's the cost of that rollover be to the economy in terms of interest repayments? Because they're all going to roll over into higher rates. That to me is a concern and why Moody's changed their mind, their tune and lowered the rating.
How much of an impact do you see this making, Jonathan? Because even though it's a downgrade from AAA, there's no real concern in that sense to the US economy, isn't it?
Well, I don't think there's a lot of concern. I think it's just putting everything together. So investors are sort of starting this trickle away from the US. They're starting to think, Moody's have moved on that. Look at University of Michigan's consumer numbers once again, and confidence numbers, they're all starting to deteriorate. Yes, we've seen some positive numbers in terms of reportings, but remember, that's a lagging indicator. We've got to look at what the companies are thinking in the next 3 to 6 months. So there's created a little bit of a picture here, which is negative, towards the US and to other economies. And I think this is just the start of this picture. Unless things change, this is a picture which I think we'll see people invest in other economies over the US.
Give us a sense of what you think is going to play out with the dollar then, because it's still hovering. I'm talking about the dollar index around that 100 mark. And does it weaken from this point? And the recent move just a little bit higher from sub 100 levels to above 100 levels, is that a brief respite?
I think you'll find the US dollar over time will continue to weaken. I mean, the central bank has to, because we have this debt situation and we're sort of moving and it's not going away for up until 2035, it's still going to be there. So I think whilst we've got this issue, I think the US dollar should remain under weak. Now, it makes sense to have a weaker US dollar because that'll stimulate homeborn exports. And that's what we know Trump actually wants. So I actually see that the US dollar, without having a policy in place to see the dollar weaker, it'll weaken by itself. And that should aid the US in terms of its exports. But that will take time. Mind you, on the flip side of this, a weaker dollar, persistent inflation has only got to be good for gold.
Oh, yeah. Okay. Any thoughts on where gold is headed? Any levels that you have in mind, as difficult as it is to predict?
Well, I mean, let's put it this way. We are seeing this natural flow where people are seeing, with all this uncertainty, gold should start to pick up again. 3,500, I think, is certainly on the cards. We've got to obviously get through this current level of resistance, but I continue to see gold. You have to have some of that in your portfolio.
John, thanks so much for joining us this morning. Pleasure speaking with you as always.
Thanks very much. Have a good day.
Yeah.